Is the SPDR S&P 500 ETF Trust the right move for your portfolio? Launched on January 29, 1993 by State Street Investment Management, the SPDR S&P 500 ETF Trust, or ticker symbol SPY, is the pioneer of the ETF world. Boasting over $770.34 billion in assets, it remains a juggernaut for investors seeking broad exposure to the U.S. large-cap equity market. But with newer, cheaper rivals on the block, should SPY still be on your radar? Let's break down the details. The appeal of large-cap blend investing. SPY targets the large-cap blend segment of the market, which offers a reliable foundation for long-term investors. Large-cap companies typically have market capitalizations above $10 billion, providing stable cash flows and significantly less volatility than mid- or small-cap businesses. Furthermore, as a blend fund, SPY captures the best of both worlds by holding a balanced mix of steady value stocks and high-growth equities. Costs and yields at a glance. Fees can quietly erode your long-term wealth, making a fund's expense ratio a critical metric to watch. While SPY charges a highly competitive 0.09% annually, amounting to just $9 for every $10,000 invested, long-term investors should weigh this cost against the fund's income potential, which currently features a 1.00% trailing 12-month dividend yield. Sector allocation and top holdings. While SPY holds roughly 505 stocks to minimize single company risk, the portfolio has become increasingly concentrated in big tech. The information technology sector commands the heaviest allocation at roughly 37.6% of the portfolio, followed by financials and telecom to round out the top three sectors. This tech concentration is visible in the individual holdings, where Nvidia Corp leads the fund at 7.61% of total assets, followed closely by Apple Inc. and Microsoft Corp. Together, the top 10 holdings account for a substantial 36.71% of the fund's total assets under management. Performance and risk profile. Designed to mirror the S&P 500 index, SPY represents the benchmark for medium risk in the stock market with a historical beta of 1.00 and a 3-year standard deviation of 14.92%. As of May 18, 2026, the ETF has added roughly 8.66% year-to-date and has surged an impressive 26.44% over the past year. During this trailing 52-week period, the fund has traded in a wide range between $579.11 and $748.17. SPY versus the competition. SPY currently holds a Zacks ETF rank of 2 for buy based on its strong momentum and asset class outlook. However, retail investors looking for buy-and-hold options should note that two major rivals track the exact same index for a third of the price. The Vanguard 500 Index Fund ETF, or VOO, manages $956.18 billion in assets, while the iShares Core S&P 500 ETF, or IVV, commands $826.14 billion. Both VOO and IVV feature an ultra-low expense ratio of 0.03%. For market insight, while SPY features a slightly higher expense ratio than its peers, it remains the ultimate choice for day traders and institutional investors due to its massive daily trading volume and highly liquid options market. For the bottom line, SPY remains a gold standard vehicle for building wealth, offering the classic benefits of passive investing, low costs, daily transparency, flexible trading, and excellent tax efficiency. If you want a highly liquid, historically proven cornerstone for your portfolio, SPY is an outstanding choice, though long-term retail investors may still want to consider cheaper alternatives like VOO or IVV to save on fees. Drop a like, hit subscribe, and let me know what you think in the comments.